Welcome back everyone to another quick stock analysis, and today we're going to talk about Visa. Now, why am I talking about Visa? Well, first of all, I must note that I am invested in Visa, and it's weird to say that in this market it's my worst performing stock, but it has, since the 2020 crash, performed quite poorly and probably behind the market. But it is worth noting that for the long term, over the past 20 years at least, Visa has significantly outperformed the S&P 500, and that's worth noting. But that's because Visa is a dividend growth stock that produces a hell of a lot of cash, like a ridiculous amount of cash. And unfortunately, through the lockdowns, we had quite a significant reduction in the amount of payments taken overseas. So there was a lot less travel, and that meant that there was a lot less payments. And a lot of their revenue actually came from online shopping. So when the news came out this week that Amazon was going to stop Visa credit cards, particularly in the UK, the market reacted very, very poorly to this. And on the day, it's actually down 5.56%, which is a lot to lose on Visa. That's a lot of volume getting crushed on Visa. MasterCard also took a hit, even though it probably shouldn't have. But there's a lot of news to digest here, and I already think this is a bit of an overreaction by the market. That's not to say Visa hasn't been doing as well recently. I personally have been a bit iffy on Visa recently and have considered selling it myself, but I don't make any decisions quickly and I don't make them lightly, so I've decided not to take any action just yet, and I'm happy to wait. I'm not here to be quicker than the market and try to get in and out of wherever. But Visa, I have done videos on Visa before, and my thesis around investing in them is simply based around their cash production and the fact that they organically grow. Basically, if you become an adult, you get a Visa card. That's mostly what happens, and you'll have your Amexes on the side, and MasterCard is very much growing. And it's worth pointing out here that this is only in the UK, and this is because, well, Amazon cites that it's high transaction fees caused by Visa. Now, there's two possible things that come out of this. First of all, you have the fact that Amazon's own credit card that it's been trying to push on its website for quite a long time is a MasterCard. It's powered by MasterCard. So there is that. There's one possible thing there, and Amazon has a habit for crushing out competition in ways like this by controlling the market on its marketplace. But also because Visa has been a little bit naughty in the UK, and this is why it's specifically in Amazon UK and not all around the world. But in the UK, the conversion fees between the EU and the UK for credit cards was capped at around 0.3%. And since we've left the EU, those laws have changed, and it's allowed Visa to charge more like 1.5% on their cards. And that maybe, and I've only heard this sort of third hand here, and I read it somewhere on a forum, but I haven't quite been able to back that up yet. But apparently, Visa says that it charges less than 0.1% of the value on the purchase, and it probably does. It probably only charges 0.1% on the actual purchase. But because Amazon does all of its counting in in Ireland, I think it's Ireland, and because it does all of its counting in EU, the conversion rate of that is actually hitting Amazon's pocket quite hard, and I think that's what this move is all about. This is a show to Visa to say, look, we're not going to be pushed around, we're just going to cancel your cards if you keep raising prices on us. And that is where Amex and MasterCard might not have had such a blow in this one, because Visa was testing its patience a bit. But it's worth noting that this is just the UK, and the overall market has reacted to the fact that Amazon is ditching Visa essentially, but that isn't all over the world, and this has caused quite a nasty push down on the price. Let's have a look at the numbers for Visa just to see if our thesis is still intact. So we have overall performance of 22.1% versus 9.9% for the past 20 odd years on Visa, 15 years on Visa. And of course, that overall performance, that ridiculously good performance, has led to the PE ratio being a little bit stretched, to the stock being visualized as a bit overvalued. What I do like to see, if I just take price off this graph a little bit, is that this is the PE ratio. This is the PE equals growth rate, the Peter Lynch PE equals growth rate of 22, and the earnings are looking like they are steadily and consistently growing. Analysts also expect that the earnings will continue to grow over the next 2 years. From a cash flow point of view, it's largely the same. It's a little bit choppier, but it's largely the same. However, you can see the difference right here when you look at the cash flow. You can see that Visa's stock isn't necessarily as overvalued as we think when compared to its cash flow, and particularly this cash flow growth of now 24 times. Taking a look at some basic numbers, we have shares outstanding, which is rapidly decreasing. This isn't gradually decreasing, this is serious give back to the shareholder. It's worth noting that Visa creates so much shareholder value with its cash, just because it's got so much cash that it doesn't know what to do with. Problem is when Visa starts relying on that growth too much and it forgets to head forward into things like crypto and different markets. But you can see that it has this gradual revenue growth every single year. It's done that for the past 15 years, with the past 5 years quite good, and the 2020 COVID blip. EBITDA is of course consistently growing. Look at that lovely revenue growth. It's been through its exponential growth phase, and it's now heading into that mature growth phase. And this is what the mature growth phase looks like for a company like Visa. Just consistent growing revenue at a steady pace. Not that smashing up. It's been through that phase. It's now in its mature growth, and this is when it starts to give back to shareholders. And this is why I feel like it was a great stock to buy. I'm not entirely sure if it is right now. This though, I'm willing to accept for now that this is just due to lockdowns, and over the next 2-3 years it's going to have a tough time, but I feel like Visa should get back on its feet in the next 2-3 years, and that makes Visa actually quite a good investment case for this time. Free cash flow runs perfectly, usually dips on acquisitions and when it decides to raise its dividend, which it does quite considerably. And it's only recently, in the past 5 years, that Visa has started to take on debt. And this is all because of general acquisitions and trying to grow and trying to solidify its place into the fintech space. And the problem with Visa right now is more that it's suffering a lot from legal legislation. It suffers a lot from antitrust. It's very hard for Visa to acquire something without making itself more of a monopoly, because remember, Visa is basically a monopoly in this state. MasterCard comes at a distant second, with Amex at a distant third. So it's very hard for Visa to acquire at the moment and make itself more insulated to competition. Most importantly for Visa is this net profit margin. It makes a net profit margin of 50% for the past 3 years. Now, I can't stress how absolutely crazy that is, and it's kept up a very high profit margin, net profit margin, remember, of over 35% for quite some considerable time. And even on its worst year ever, arguably its worst year since it started, it's still managed to rake in a 47% profit margin. So this is one of the few businesses out there which is organically growing and organically has this high profit margin. It might obviously do itself some favors by reducing some of those profits with Amazon, but still it's going to continue to be a growth machine. You can see me trying to sort of talk myself back into buying more at the moment. Remember that Visa's normal PE ratio is around 26, and that seems to be very similar for the rest of its competition. And if we take analyst estimates and set the PE ratio at 26, we do see quite a positive growth outlook for Visa, with a total annual return of 13.53%. I tend to aim for around a 10% model if I can, and that's a full capital appreciation, including dividends, and that probably doesn't include share buybacks right now. It's a full capital appreciation of 104% by the year 2027. Now that's not bad for a normal case, but let's try and make this much worse than it already is. So let's try and set this PE ratio back down to a 15. That would be a worst case scenario right now for Visa, and let's absolutely slash its growth right back down to 15. So I would consider that a 15% growth rate going forward and a 15 PE ratio, based on the fact that that growth rate has gone missing, we would still find a 0.2% annual rate of return, a capital depreciation of 4.71%. But because of that tiny dividend, you still end up with 1.2% of total return. Now, is this a proper worst case scenario? I can't really know, because this bit is all about the guessing. This bit is all about you deciding how bad or how good it could go for Visa. Now, I could sit here and I could say, oh yeah, in 5 years Visa is going to have a PE of 60, and lots of people do random stuff like that. In that case, you end up with 25% a year. Obviously unlikely to happen, but if we set realistic expectations, so a 26 PE in 2027, you end up with a 9.5% return. I don't think for a second that Visa in the next 5 years is going to stay at a premium of 26 times earnings. I think it's more likely to be back down at 18 times earnings. But let's say it continues its 30% growth rate. Let's give it a 25% growth rate just to... This is like a midline conservative view, terminal value of 18, and a midline conservative view. You still end up with a total annual return of 12% a year, which isn't that bad. So I do see that Visa does have possibilities of making some money still right now, especially with this recent drop. A 5% drop on Visa right now, cash flow growing business. There really is an investment case for this right now. I thought Visa would have been ridiculously overvalued, but actually looking at it in its worst case scenario, you do have a relative margin of safety coming in here. Not spectacular. It's not that Warren Buffett spectacular business at a low price. It's somewhere in between. Thank you very much for watching, guys. If you enjoyed this video, please feel free to like, subscribe, and invest.